Joining us now is RBC Capital's head of emerging markets research. He's Nick Chamie, and he joins us. And Nick, of course, all emerging markets in one way or another are tied to the U.S. economy and the global cycle there. But which of the markets is the most vulnerable to the slowdown in the U.S. recovery?
Well, certainly the Mexican economy will be the most vulnerable to the U.S. slowdown. Obviously, a very large chunk of its exports, somewhere in the order of 80 to 85% of its exports are headed to the U.S. And as a result, Mexico will feel it first and foremost, and certainly into Central America. But when you look at emerging Asia or South America, Central and Eastern Europe, they're going to feel the effects a whole lot less.
And when would they likely feel the effects? When would we see that?
Well, in Mexico's case, it'll probably come with only a 2 or 3 month lag. As for the rest of the emerging market regions, it'll probably take somewhere between 6 to 9 months. So it certainly could be that late this year we could see the effects of the U.S. slowdown being felt more materially across the emerging markets as an asset class. But however, having said that, domestic demand across most emerging markets remains quite strong, and that seems to be the primary driver for growth in the immediate term.
Okay, you see a lot can happen in the next 6 to 9 months. For Brazil, you've got a presidential election coming up, one that's going to make a huge impact. What kind of impact will the elections have on returns? What will it do for the interest rate tightening cycle that we're seeing in Brazil?
Well, largely the two leading candidates have very similar platforms, and in fact, most experts expect that there will be very little real difference to the full macroeconomic picture in Brazil, regardless of who wins. In the end, we expect that Brazilian growth will remain quite strong, and that in fact for the interest rate cycle, it's taking a pause here, but next year we should probably expect to see more interest rate hikes as the domestic demand remains red hot.
Okay, let's move on to another BRIC nation, which is China. You've signposted China as one with overpriced bonds. The common thread between China and some other countries like the Czech Republic and Malaysia is that yields are too low right now.
Well, certainly we expect that the economies will continue to recover there, and we're likely to see interest rate increases as opposed to decreases over the coming year. And that should likely put some pressure on domestic bonds. But having said that, the inflow of capital into China will likely remain quite strong. So generally, yes, we expect them to underperform, but we expect emerging markets in general to have a strong performance.
Okay, underperform in the context of emerging markets, but still outperform what we're seeing here in developed economies.
Exactly.
Nick, last question. What is the main challenge or deterrent in investing in emerging markets debt? Is it liquidity? Is it the spillover effect from the developed economies? What would be the big hang-up?
Certainly the global context will remain challenging. While domestic fundamentals remain quite strong, I think the global context will remain challenging. But having said that, generally the difficulties that investors find in emerging markets remain centered around liquidity. Many of these economies are only in the early stages of opening up their markets to the rest of the world,
right,
and they're facing significant inflows.
All right, we thank you for your time. I've been speaking with Nick Chamie. He's the head of emerging markets research at RBC Capital Markets.